Black delivered its Q1 numbers. It's been quite a steady set from what I'm looking at, because we do have the profits which have close to doubled from 48 crore rupees in the corresponding quarter to all the way coming up to 97 odd crore rupees. Even for that matter, the revenues have come in at 781 crore rupees versus a figure of close to 590 crore rupees. To talk a bit more on the numbers, we are joined now by Mr. Sanjeev Goenka, the chairman of Phillips Carbon Black. Thanks so much, Mr. Goenka, for giving us your time on ET Now. Good afternoon. Congratulations. It looks like quite a strong set delivered by the company. And we were anyway, working with a strong set of numbers given the positive momentum in the chemicals business. So if you could talk to us about the key takeaways in Q1, what were the highlights? And also if you could throw some color on what the volume growth was like in specialty products and the price realization trend.
Okay, so I think quite honestly, the bottom line actually gives the story. This performance is actually reflective of several quarters of hard work across multiple fronts, from manufacturing to logistics to alternative raw material supplies to better yields, and more importantly to actually focusing on value-added products in the rubber category, in the non-rubber category, in the specialty category. And 2 years ago, we were virtually non-existent in this value-added category. Today, this year, we actually plan to sell about 36,000 tons in this segment. And the contributions here are significantly higher. And therefore, on a unit basis, you actually tend to make a lot more money. Last year, we finished at 18,000 tons for value-added blacks. This year will be 36,000 tons. So it's a huge jump forward.
All right, that's good to know. You said you are more or less absent in the value-added products. I want to talk about that. How has that contributed to the overall volumes and to the overall top line this quarter?
That's fairly significant, and this will keep growing. The focus on this keeps growing year on year. We've just commissioned a very new R&D center at Palej in Gujarat, and we are in the process of finalizing another center in Europe, which will actually help us to do basic research on and applied research on applications of carbon black in different industries and value-added products. So the way forward for us is going to be running an extremely tight ship in terms of operations, expanding capacities in commodity blacks, but actually growing much more in value-added blacks.
Okay, fair points, Mr. Goenka. What was the split between domestic and export sales, and how do you see the export sales shape up for the rest of the fiscal?
The huge path for the step forward on the international markets has been acceptance by Bridgestone and Goodyear for multiple countries and multiple factories. We are a little constrained by our existing capacity as it stands, so we are not able to ramp up the volumes in exports significantly. But we are, I had earlier said that we are going to add 88,000 tons by debottlenecking capacities and facilities in our plants in Mundra and Palej. Our plant in Mundra is actually ahead of schedule, and we hope to commission that by early December as opposed to March, which was the target date. Our Palej plant will be commissioned on schedule by the second quarter of next year. As far as a grassroots facility is concerned, which we were looking at South India, we had looked at Tamil Nadu very intently. We are also now looking at Telangana and Andhra. And over the next 2 months, we want to finalize the exact location of the plant, and then we will start work on it. So that will give us another 150,000 tons of capacity, which will then hopefully give us enough to cater significantly in the international markets as well.
Okay, that's good to know. So we spoke about what exactly your expansion plans, how they'll progress. Let's talk about the margin bit. there has been tremendous improvement over there as well, from 15-16% in the corresponding quarter. It's now jumped to 20%. What exactly drove that? Because we know product mix is one, operating leverage as well. So was there any other favorable factors, like for example tailwinds from lower input costs, and would margins stay in that above 20% range going forward?
So product mix, of course, is a significant factor there. The improved efficiencies of the factories is a second factor. Having alternative sources of raw material supply is a third factor. And actually tightening up logistics in terms of importing to a particular port or exporting from a particular port have been a fourth factor.
Great, Mr. Goenka. We wish you all the very best for all your future endeavors. I hope we can chat next quarter as well. And until then, thank you so much for joining us on ET.